E agora, sem mais delongas, quero chamar o Joe, que vai fazer a apresentação dele, e depois a gente tem um espaço para perguntas. Uma salva de palmas, por favor, para o Joe.
Obrigado, Vinícius. That's all my Portuguese, so thank you for having me, and thank you for Empiricus for putting today this event. As I was chatting with the team earlier today, I'm very impressed with the work that everyone at Empiricus has put together in getting this course going, and the way that they have approached teaching and educating investors around what's going on around crypto assets. Today I'm going to talk about investing in crypto networks. I'll tell you a little bit about myself first and where I'm coming from. My name is Joel Monegro. I'm an investor. I'm a venture capitalist at a venture capital firm called Placeholder that I co-founded in early 2017. And we invest exclusively in crypto assets. And the way we came to focus on this space, I'll take you a little bit through my background just so you have some context. It all started in 2013. I was working for the government of the Dominican Republic, where I'm from, where I started a department called the Digital Economy Department, which was meant to figure out and design public policy programs and government programs to help the local startup ecosystem. And related to that, one of my mandates was to figure out payment system reform. And through that process, I was trying to figure out how to solve some of the structural issues of our national payment system, and realized that there's a bigger issue or a bigger problem around Latin America, around payments. And as I figured out that there was no way that I was going to work through the government to try and solve some of these problems, I found Bitcoin and realized, holy shit, here's a technology solution that can really solve some of the problems that we have. And that started my journey through first cryptocurrencies, and then discovering blockchain as a technology, and then crypto assets later. In 2014, I moved to New York and joined another venture capital firm called Union Square Ventures that has been in business for a long time. Actually, they were the first investors in Twitter. And as part of my work at Union Square Ventures, I began investing in crypto companies. We were the first investors in Coinbase, or one of the first investors in Coinbase, in 2013. And 2014, we started investing in some early stage companies that were trying to use this new technology to introduce new business models. And we had no idea how any of these businesses were going to work. We had no idea how we were going to make money off of these, but we still went and took the risk, and as is the job of a venture capitalist, took the risk and learned a lot from making those investments. And around 2016, after 2 years of trying and failing to make some of these businesses work, I went back in time and looked at our most successful investment in the space, which is Coinbase, a popular online Bitcoin wallet, and went back and saw, okay, what if every time that we put money in Coinbase, and we had put several millions of dollars into the company, what if we had bought Bitcoin instead? What would that look like? And so I went back in time and looked at the price of Bitcoin at the various dates in which we invested in Coinbase, and found that it would have been a much better investment to invest in Bitcoin directly, as opposed to a company building on top of Bitcoin. And that was the first hint that the new interesting thing here was to invest in the crypto assets themselves, in the cryptocurrencies, in the new assets that are being created with this technology, rather than in the old model of venture capital or investing that we were used to, of investing in companies. And that was the journey that that took me through this period of growing up in sort of traditional finance and traditional investing, and then realizing that we were latching onto something really big and really important here. So today's agenda, I'm going to tell you a little bit about our firm, about Placeholder, so you have a little bit more context about what we're about. I'm going to tell you about our investment thesis, which is a thesis that we developed when we were raising our first fund, and how we articulated the opportunity of crypto to investors. Then I'm going to talk a little bit about the market, and this is an area that you've probably studied now quite well, where we're coming from in terms of how this ecosystem has evolved by looking at the charts and prices, where we stand right now, and what we think the future looks like in terms of the market for these crypto assets. Then I'm going to share where we are looking as investors for opportunities, what kinds of applications, what kinds of crypto networks we're looking for, and why we're looking for those opportunities. Then I'm going to run you through the framework that we use to evaluate potential investments as we see entrepreneurs come to our firm raising funds for their crypto networks. And then we're going to end up with a Q&A session. So Placeholder, that's the name of our firm. We couldn't come up with a name, so our lawyers did. I started the firm with my partner, Chris Berniski, and I met Chris in 2016, and I was coming from early stage venture capital. Chris was coming from public markets investing. He was a public equities analyst at a ETF manager called ARK Invest, and he had a similar story arc where he joined ARK in 2014, found Bitcoin, went down the crypto rabbit hole, and ARK ended up becoming the first public asset manager in the United States to include Bitcoin into an ETF. So it was the first time that retail investors could get some exposure to Bitcoin using a publicly traded vehicle. Chris and I met sometime in 2016 after we bonded over the shared realization that what was interesting here was not the companies building around crypto or around blockchain, but the investing in the assets themselves that this technology facilitates. We decided to start a venture capital firm and not a hedge fund or any other kind of fund because we realized that this is a brand new technology. It's a new technological revolution. It's like the internet before it or like computers before it. Really, the paradigm that exists for, or the new paradigm for creating software services and online services facilitated by this technology requires a venture capital mindset. What's different here is that the assets are public. In the past, for venture capital, if you look at Amazon before it went public, or Twitter before it went public, or Google before it went public, only venture capitalists like ourselves, or like the firm that I used to work at, like Union Square Ventures, were really able to invest in these opportunities, to invest in these companies before they were open for the public to invest. And that's kind of a feature more than a bug, in the sense that early stage companies are very volatile. The failure rate, as was presented earlier, is 95%. 95% of technology ventures, 95% of technology startups are going to fail, are not going to exist. And so as a result, it's a very risky business to invest in early stage technology. But here we have this interesting intersection of early stage technology venture opportunities to invest. But now with these crypto assets, they're open to the public by and large. So people now can go and invest in early stage technology opportunities in a way that they really couldn't before. But that doesn't mean that it's any less volatile than it used to be, and that's why the failure rate is so high. By the time a typical company goes public and is available for people to purchase on exchanges or New York Stock Exchange or through your broker, it's a mature business that has been around for a really long time, or for at least a couple of years. And the true failure rate of a company going bankrupt is much lower than when you're taking the risk of investing early stage in technology. And so we decided to start a venture capital firm, understanding that while the assets were public and we could start something like a hedge fund where you're able to trade back and forth and really operate the public markets that way, we recognized the value of taking the venture capital mindset, of taking a really long-term view and investing the same way that venture capitalists have invested in early stage, highly risky ventures, which is take a really long time horizon and don't focus too much on the short term, because the short term is going to be very volatile, but the long term is really where the real value and the real growth is. So, placeholder, we're a thesis-driven venture capital firm. We're based in New York City, and we invest exclusively in this asset class. I kind of ran you through that, but this is, I think, an important slide for comparing the hedge fund model and the venture capital model. And the reason I'm going to share this with you is because you can decide if you want to adopt one of these models in your own investing. You can decide to invest your capital personally, more like a hedge fund investor, and that is totally fine. We do the venture capital style because it's what we're good at. It's what we're best at. But you can really take two approaches. What that means more in the professional space is, in a hedge fund model, you have a more liquid structure, meaning that investors in a hedge fund can withdraw their capital typically about every 90 days or so, or every quarter. And so people put money into these funds, but they can also withdraw it pretty much whenever they want. In a venture capital model or in a venture capital fund like the funds that we run, it's what's called a committed capital structure, meaning that our investors cannot pull their money out of our funds. In fact, our fund in particular has a 10-year life, meaning that the investors who put money into our fund cannot withdraw it for 10 years. And that really allows us the flexibility to take a long view and invest for the long term, because we don't have to worry about our investors pulling their money out next quarter or next year. We can really take big risks and invest with a long time horizon because we don't have to worry about that. In a hedge fund model, typically it's an active trading model. You're typically in the market every day or every couple of days making decisions about how to reallocate your capital. In a venture capital model, we're not trading, we're not in the market every day figuring out the different prices and how to profit off of fluctuations in the market. Rather, we're mostly buying and holding. And the motto that we use internally is we buy often and we sell once. And so we have a 10-year fund. We have a long-term time horizon. When we make investments in crypto and we're out in the market, we're mostly buying and we're adding capital to the ecosystem. We never sell when we expect a drawdown and when we expect prices to go down next week or next month. We actually take the opposite approach. Instead of trying to sell in order to prevent a loss at that point in time, we wait for the prices to go down and then we buy some more. Another internal thing or motto that we use is when things are going down, that's when you want to buy, and you just keep buying when you have conviction, and you keep buying, and you're just getting better and better prices. Hedge fund model is an active market participant, so a hedge fund or an active trader, as I mentioned, is going to be buying and selling at a relatively high frequency. In venture capital, we're not buying and selling at a high frequency, but we are participating in the network actively. And so in our business, we get quite involved with the core developer teams or the entrepreneurs behind these opportunities, and we help them develop their business. Because at the end of the day, these are still young teams and these are still early companies that face a lot of problems. And so some of the help that we can provide as venture capitalists is help them work through the challenges of building a team and building a company and building a service and really scaling it. And the way we see it, this gives us a better view into what's going on inside the team that's developing these networks, and that allows us to make smarter investment decisions. One way that you can translate that into your own investing is really following the activities of the teams and the entrepreneurs. You can follow them on Twitter, you can follow their forums, you can follow their blogs, and really see what they're working on and get a sense for how the team as a team is developing, and that'll give you information about whether you have conviction in this opportunity for the long term or whether you want to exit early. Hedge fund doesn't really care that much about the stage of the company in terms of how long a company has been around or how mature a company has been around or a network has been around in the case of crypto. In the case of venture capital, we focus pretty much exclusively on the early stage. So teams that are about to release a crypto network or a crypto asset or will release one in the future, or ones that are already out there but fairly small. And so in our fund, we don't hold Bitcoin or Ethereum. We do hold it personally. We think those are valuable long-term investments. But for the purpose of our fund, we look for opportunities where the relative value in the market is much smaller and therefore the upside is potentially higher. And so in venture capital, we really try to find early stage opportunities that people haven't yet identified at large, and then we invest in those, and then the potential return is much higher if you select those investments appropriately. Finally, a hedge fund tries to predict short-term volatility and take advantage of those movements. So you're really looking at as much information as you can. You're on coinmarketcap.com every day, looking at the prices and seeing how things are going up and down and trying to predict whether something's going to go up 5% or 10% or 20% in the next week or month or down, and then you kind of rebalance your portfolio accordingly. In our business, we don't try to predict the volatility. It's actually quite hard, and I don't think we as a team would be quite good at it or particularly good at it. But rather, we take the approach of selecting quality teams, selecting quality services and quality products, and then investing in them consistently over time. And that allows us to get an average price, especially when you're dealing with these public assets. Rather than try and think, okay, let's figure out when's the best time to buy, we use a technique called averaging in. So when we decide that we want to make an investment into a network that's public, and we decide, say, we want to make a $5 million investment into this opportunity, rather than try and predict the best time to do it, we will do something like buy $100,000 every day consistently, no matter what the price is. And taking a long enough time frame, say a couple of weeks or a couple of months, then we get a good average price over that period of time. And it just makes it easier to manage, because then we don't have to suffer through the volatility or the emotional intensity of watching the market, especially in a place that's as volatile as crypto. You can take any of these approaches. Some people are very good at actively trading, and it's a skill that you can develop, and it's a skill that you can apply in your own investing. Or you can take the venture capital style of selecting really opportunities that you believe in or teams that you believe in, and then supporting them long term, and purchasing those assets and then holding onto them over the long term. It takes a little bit of discipline, because sometimes it will be down and sometimes it will be up, and it takes a lot of internal strength not to sell when you think that things are going down, but to actually keep buying. But if you do it correctly, the potential payoff is much larger. I'm going to run you through the first part of our investment thesis now to switch. And taking the view of the history of information technology as a space, I know that in the course you looked at crypto, you learned about crypto in the context of the history of the financial industry, and from some of the presentations today, it was great to see it put in the context of technological revolutions. This is a slide that we had in our own fundraising deck when we were raising our fund from our investors, and this is the result of about 2 years on my end of studying the evolution of information technology to try and understand how blockchains and crypto fit into the broader history of technology, and chose to start around 1950, which is really what I would consider the birth of information technology. And that was following the introduction of the transistor, a tiny little part that became a fundamental component in the production of electronics. And the transistor came along in 1947, and that kickstarted the whole consumer electronics booms. Now we have TVs and radios and all kinds of consumer electronics. But the other thing that we could do with electronics that were powered by transistors is build computers. And that was the hardware era, or the computer era, that began in the 50s and the 60s, where we had these big computers and these big innovations with mainframes, and we got basically IBM was born in that era. And what happened from the 50s and the 60s is we got this explosion of computer manufacturers in the United States. In particular, there were about 8 or 9 or 10 big computer manufacturers that were working on mainframes. But over time, as that market developed, it very quickly consolidated around IBM. IBM became the dominant computer player towards the end of the 60s, and everyone else had pretty much kind of disappeared or had a very small share in the market, and IBM was the dominant one. And so we had gone through the cycle of, we introduced a open technology, an open architecture around the transistor that allowed for the creation of a new product or service, which was the computer. That industry boomed and exploded, and it was a very profitable time to invest in companies like IBM. IBM became a huge business, one of the most important businesses in the world, and it then quickly consolidated the entire market, and then it was pretty much just IBM. And so at that point in time, it would have been very silly to try and invest in an IBM competitor in the late 60s around that time, because it would have been very hard to go and compete against such a large company. What happened going into the 70s is that we got another new technology, another open technology, the microprocessor, following the transistor. And what the microprocessor did is that it went and directly attacked IBM's business model, in that in the times of IBM, computers were these very large and complex systems of electronics where CPUs were custom built for different applications. And so IBM would go into a company like a bank or the government and design a custom computer that could only do the things that IBM designed it to do. The microprocessor instead was a small component, relatively small component, relatively cheap, that was more of a general purpose computer. And it became the standard CPU for what became the sort of personal computer revolution, or even all the way through to today, the phones in your pockets are still based on the microprocessor architecture. And what that allowed the technology industry to do is to completely erode IBM's business model, because now everyone had access to a microprocessor, or anyone could purchase a microprocessor and build a computer. And that's when we got mini computers and PCs and so on. We got Dell and Compaq and HP and all of the computers manufacturers that were now building smaller and smaller computers based on the microprocessor, because the hardware became standardized. And that made it very difficult for IBM to maintain a large computer business, but it created this new open market. Now the hardware industry was open. Now it wasn't just one company. But what happened is that as the hardware layer got commoditized and that market got decentralized, the new value creation moved one layer up in around the 70s and the 80s to the software layer. It's the stuff that runs on top of the computers. And that's when we got Microsoft. And Microsoft came in the 70s building an operating system. Because now what happened is you went from one large computer manufacturer, IBM, to dozens of mini computers and PC manufacturers, and they all needed an operating system. And Microsoft came in with a completely different business model of just providing the operating system, and it really helped kickstart the PC software industry and the PC software boom that occurred in the 70s and 80s. And so in the 70s and 80s, as the hardware era, as the IBM era was unwinding, the software era was booming, and the place where you found a lot of value was in investing in PC software companies at the time. Similarly to what IBM did to the computer business, though, as that industry developed over those 20 years, Microsoft emerged as the winner and started consolidating the entire ecosystem. And so, just like with computers, where we went from a bunch of computer manufacturers to basically just one with IBM, with Microsoft, we went from a bunch of different software manufacturers and operating system vendors to basically just one Microsoft and into the 80s and into the 90s. And then in the early 90s, we get yet another open technology that comes to market, or actually two technologies in this case, which were Linux and the internet. And what's interesting about the combination of Linux and the internet is that they both directly attacked Microsoft's business model the same way that microprocessors directly attacked IBM business model, in the sense that Microsoft's business was based on two things: proprietary software that was closed source, so a proprietary operating system. Windows is still today closed source, and Microsoft owns the entirety of Windows, and it's not open source to developers. And then the internet gave us an open distribution system, because now we could distribute software over the internet for pretty much free. And Microsoft's business was not only just the proprietary operating system, but they also had a retail distribution network that was larger than any company in the world. And so they could put more CDs and more shelves than any other company in the world. And so it was very difficult towards the end of the 80s and into the 90s for a small PC software company to go up and compete against Microsoft. And so Microsoft took over that entire market. But along comes the Linux and the internet and completely erodes that business model. And so over that time frame, we get the emergence of the internet, we get the emergence of Linux. The new software development paradigm was now based on those two new technologies, and we got companies like Google, Apple, Facebook, and Amazon. And now we're getting into the territory or into a part of history of IT that we all kind of remember, as we saw that develop over time. And now we're at this point where we're in a similar place in the market as with Google, Apple, Facebook, and Amazon and other large web companies, as we were with Microsoft into the 80s and the 90s, and IBM into the 70s, where there's pretty much these four large companies that have now taken the entire web market, and it's very hard for a new technology startup operating the web to go and compete with Google, to go and compete with Facebook, to go and compete with Amazon. If you've been on the internet for a while, you kind of have seen this. We've seen how we had a whole bunch of different websites and a whole bunch of different applications in the 90s, in the early 2000s, and now more and more and more, we spend more of our time on Google, on Apple, on Facebook, on Amazon, and not really in many other places. And so as an investor who invests in early stage, highly risky technology opportunities, this is not a really good environment to play in, because Google, Apple, Facebook, Amazon are already pretty large businesses. And if you're left trying to figure out where to find opportunities around these four big elephants, you're going to have a hard time, because now startups that are coming out in tech are having a really hard time competing with these incumbents, and are having difficulty really finding success, because now either Google or Facebook or Amazon copy their products, or they completely squash them, or they buy them pretty early on. And so it's hard as an investor to find opportunities there. I mean, even if you think about it on the web, the only two most recent really massive consumer successes on the web are kind of Snapchat and Uber. And Snapchat is really struggling in the face of Facebook, pardon the pun, and as Facebook copies more and more of their features, and people kind of abandon Snapchat and just use Instagram, and Snapchat is really struggling to build a business. And Uber has yet to really proven out its case, especially as we see companies like Google, as in particular, beginning to go into Uber's market. And so we'll see how that plays out. But both of those companies, if you think about it, they're almost 10 years old. There hasn't been any big web consumer services successes that have been successful in the last 5 or 6 years, which is really a testament to how consolidated the web has gotten. And so when we look for the next cycle, the next opportunity, the next open platform and technology that's going to do to Google, Facebook, and Amazon and Apple the same thing that the internet did to Microsoft, or that microprocessors did to IBM, we're forced to look for an open technology that is available to developers worldwide, that you can really innovate on, and that directly attacks the business models of these incumbents. And we find those properties in blockchains. And the way that we find them in particular is that blockchains are open data layers. They're open data technologies where all of the data that is produced by a crypto network, if you think about it, is open to the public, and it's kind of open source. If you think of Bitcoin, the way Bitcoin works or the way a cryptocurrency works is by sharing all the information, sharing the ledger with every computer on the network. And so as a result, there isn't this single company that owns all of the data in Bitcoin. In fact, all of Bitcoin's data is open to the public. Very different from the closest analogy, which would be PayPal, where there's a single company that's in charge of the whole data, and that allows them to maintain their monopoly over their payment service. Bitcoin is a completely different kind of development model. And if you think about it, Google, Apple, Facebook, Amazon, their entire business is based on proprietary ownership of data that they own and they control, and that they use it to keep us locked into their servers. The reason we can't leave Facebook is because Facebook won't let us take our data with us if we want to leave, and won't let other people take their data. But in a blockchain or in a crypto network, all the data is open, all the data is public. So we start to see how that immediately attacks or goes against the business model of the incumbents. And the reason that's important is because it means that crypto networks that come to market and become successful, the established incumbents that operate on the basis of proprietary ownership of data cannot compete with an open data alternative, because their entire business model is based on the data being closed. And so our thesis is that we can attack Google, we can attack Facebook, we can attack Amazon with open data, because they will be unable to react to a competitor that completely erodes their business model. I like to call that incumbent paralysis. It's not that these companies don't see the revolution coming, it's that they are unable to act. For example, Microsoft saw the internet coming very, very early on, but it was impossible for Microsoft to walk away from their business of selling you software for $300 a year to try and compete with Google that was giving away the software for free and instead monetizing with advertising online. So to recap some of the theses and make it a little more concrete, first is the web has reached maturity, and for technology investors and startup investors, it's just really hard to find opportunities on the web, it's just a bad idea to try and compete with Google, Apple, Facebook, Amazon in their own turf. And so it's going to be pretty difficult for traditional venture capitalists or early stage investors to find opportunities when you have these big companies that can really outcompete anybody else on the market. And so we have stopped looking for opportunities on the web, and we're starting now to look for them in crypto, where we have an opportunity to win and compete. The second is that the next technology cycle will be based on open data, and this is the conclusion from this study of history of how open platforms and open standards emerge and directly attack the business model of whatever the incumbent or established companies are at the time. Just to recap, the microprocessor directly attacked IBM's business model of proprietary hardware, and then Linux and the web directly attacked Microsoft's business model of proprietary software and proprietary distribution. Blockchains directly attack Google, Apple, Facebook, Amazon's business of proprietary data, and they do it with open data. And finally, there's this very important element about crypto networks, which is what gives us the most amount of long-term conviction, which is that these are decentralized networks. And the last time that we saw a decentralized network come to market and take over the world, it was the internet. And when you think about it, there's nothing out there that has the scale of the internet in terms of coming and really swallowing the world with this global communication service. And we attribute that to the fact that the internet is decentralized. There isn't a single company that is in charge of deploying the internet. Rather, the internet is a series of open protocols and open technologies that different countries and different cities and different towns decided to implement on their own. And networks like Bitcoin and Ethereum and crypto networks that are decentralized share some of the same qualities, where there isn't a single Bitcoin company that's out there trying to create this Bitcoin service, kind of like PayPal did for payments, but rather it's an open technology that developers and people around the world can decide to contribute infrastructure to. And that is what happened with Bitcoin, and that's what allowed Bitcoin to scale. People decided to grab their computers or to set up mining data centers and to really provide the infrastructure, and that allowed us to create a global payment service. We can take the same architecture and the same design philosophy to create alternative online services that have the same design and have the same architecture, and as a result of being decentralized can really achieve true global scale in a way that Google, Apple, Facebook, and Amazon, even though they are massively large businesses, they haven't yet. They haven't really covered the world in the same way that the internet has covered the world. So this leads us to believe that these crypto networks that are truly decentralized will achieve levels of scale that we haven't seen before, and will really be able to cover the world in these services as this market develops over the next 10, 20, 30, 40, 50 years. So let's look at the market and look at some charts just to put some of this into perspective and into context in terms of what's been going on over the last 10 years. This market is only 10 years old. The Bitcoin white paper was released in late 2008, first implemented in early 2009. So we're about to hit that 10-year point. And that's just a testament to how early we are in the development of this space. Bitcoin is 10 years old, but crypto as a market or as an idea is barely 3-4 years old in terms of when we started to develop other kinds of services different from Bitcoin that use the same design philosophy. This is the market 5 years ago, and many of you will be familiar with this chart. This is kind of May 2013 to May 2015. I took this 2-year period because this was the first big bubble, and we called it a bubble. And at this time, I was actually working for the government of the Dominican Republic, and I gave a presentation to the central bank around Bitcoin, and it was around this bubble and how it was playing out. And this was insane, right? You can see this growth. We went from $2.5 billion in terms of total market cap for the whole crypto space. We didn't really call it crypto back then. And then in November 2013, up to very early in 2013, we had this massive rise where we went from about 2 to 3 billion in value to over 15 billion in value. And then it crashed massively in early 2014, and then it tried to recover, but then we kind of were stuck in this very sad period from 2014 into 2015, where we just kind of declined consistently, and there were these little bouts of optimism and hope, but by and large, we kind of slid down all the way through. And this was the period in time when I was at Union Square Ventures investing in crypto companies, and it wasn't a very fun place to be in because everyone thought that this space was dead and that this opportunity was really not going to pan out. We really went from that 15 billion, if you take it over those 2 years, it was a very long and drawn out 80% kind of decline over time. And for many people, a lot of people sold and got out of the market and sold at a loss and really didn't hold on to for the long term because they were taking a short-term view. Fast forward to where we are today, and there's this now cute little $15 billion bubble that was so crazy back in 2013 and 2014 where everyone was going crazy. And now it's this tiny little bump there that it's barely recognizable. And this is the kind of wild craziness that we find ourselves today. In 2017, we've all seen this. We got this massive rise all the way up to 800 billion, almost $1 trillion worth of value. And then we crashed, almost kind of repeating the same pattern where we had this incredible rise towards the end of the year, and 5 years later we find ourselves in the same position. And this is where we find ourselves today. We find ourselves 80% down from the all-time high of $800 billion in total network value, total market value, much in the same way that we found ourselves 80% down from the 2013 bubble. But what's fascinating about this is that even today, even when we're 80% down from where we were at the beginning of the year, we're still up 15 times in the last 5 years. And we haven't seen this kind of growth in any market, or we rarely see this kind of growth in any market. It only happens when we have these very important technological revolutions that are really changing the world. And just as we saw with the 2013 bubble and the aftermath, the couple of years that followed the 2013 bubble, we had this long and prolonged decline, and people who sold out during that point in time did not participate in the massive growth that occurred just a couple years later. And the way we see it, we're entering a similar period where it's actually kind of eerie how similar these charts are, because if you remember the 2013 chart, there was this rise and then crash and then this attempt at a recovery in early 2014, and we just kind of straggled along for a couple of years. This looks like the beginning of that same kind of pattern. And so we think, as investors in this space, we think that we're entering a similar bear market period where we're going to have this sort of period of instability and volatility, but largely trending down. But we believe that it's going to be just like the 2013 bubble eventually ended in this other massive rise. We believe that in a couple of years, we're going to encounter a similar situation. We're going to reach higher levels than we did before. And this bubble will eventually look like that little bubble over there as this tiny little speck, and this one is just going to disappear from history. So we think that this is the best time, or one of the best times to begin investing in this space and to really start deploying capital, but you have to do it with this perspective of a long time horizon. Again, if you adopted a short-term perspective in 2014 and 2015, you would have sold out and wouldn't have participated in the growth that occurred in 2016 and 2017. Similarly, people who are selling out and not really sticking for the long term in this period of a bear market are probably not going to participate in the growth that will occur later on in time. So it's important to put this in context, and there's actually a whole body of research around how technological revolutions and financial markets interact with each other and why these bubbles happened. And these technology bubbles happened it happened in the 90s with the internet, and it happened in the 70s with PC software, and it happened in the 60s with computers. And we actually borrow a lot from the work of a researcher called Carlota Perez, and she wrote this book. She started this work in the 80s and published this book in the late 90s called Technological Revolutions and Financial Capital. And she's an economist that did a broad study of how different technological revolutions have emerged, way beyond information technology, looking at how even go as far back as the automotive boom or railroads or electricity, really thinking about how different technologies have come to market and affected the world, and the different financial bubbles that have occurred around the occurrence of these technologies. And in this book, she proposes this framework based on her historical research that explains how technologies and financial capital interact over time when things occur. And she basically describes these two phases in the life of a new technology: the installation phase and the deployment phase. And the installation phase is kind of this 20 to 30 year period when the technology is new and still being developed. And within this period, there's two other sort of sub-phases: the eruption phase and the frenzy phase. The eruption phase lasts about 10 to 15 years, and it's when the technology is first invented, and it kind of just hangs around for 10, 15 years, just being developed, and the use cases are unclear, and people are not quite interested in them, but it's mainly the early developers or the early engineers who are kind of toying with it. So if you think about the very first railroad was kind of a cool demo, and then nothing happened for a couple of decades, or it took a really long time for railroads to really transform the world. Similarly with electricity, we discovered electricity, but it took a couple of decades for it really to permeate the world. And cars, same story. We had early cars that weren't really all that good, but it took a couple of decades for cars to really end up affecting the world. So we have this period of eruption. Then after a period of that early development comes the frenzy, and this is when the use cases become more clear and the applications become more clear and the technology matures just a little bit more, and now the public at large and investors at large begin to recognize the potential of this new technology, and that's when a lot of investment comes into the market, and it comes at a very rapid rate because there's a lot of expectations around the future, and so we get this big rise or this big growth in value. And it ends up in an inevitable crash, because the thing is that these curves describe more how financial capital moves into technology markets, but the pace of development is not as exponential. And so what happens during the period of frenzy is that a lot more capital goes into the market than technology being developed. And so we have this period of time where there's more money than actual technology in the space, and so it creates this bubble, this frenzy, and at some point in time that collapses because there's a point at which the technology cannot really truly deliver on the expectations of the rush of capital coming in, and we get this massive crash. But that's all good, because the reason this happens and the value of this period is that this period of overinvestment actually helps get the technology developed, because that means that there's more companies coming in that are getting funded, that are playing with the technology, that are developing new applications, and are actually pushing the technology forward. So what happens after the crash, according to Carlota's framework, is there's a period of recomposition where we all kind of as a market realize, okay, now we've overinvested in this technology, but it actually helps develop the infrastructure. And once you've developed the infrastructure, you are able to really go into what she calls the period of synergy, where or after the recomposition, where now financial capital and technology have a much tighter relationship, and the technology is now actually kicking in and delivering on its promises. And then after 10, 15 years of that, we get to a period of consolidation, which is when the market begins to consolidate around a small number of players. And it's kind of the history that we went through with how, for example, IBM, it was early on, we have the emergence of computers actually in the 30s and the 40s, which would be the eruption phase. And then the frenzy began in around the 50s after about 10 years of the transistor, and we got a lot of overinvestment into mainframes and so on. And then over time, it consolidated around IBM. Same thing with Microsoft. The more recent one that many of us might remember may be the web. You could consider the emergence of computer networks in the 80s to be the eruption phase, when we were kind of starting to figure out, okay, we can connect computers together and they can work together. And then in the 90s, we had the frenzy phase once we realized, oh, we can actually build a lot of applications on computers talking to each other, and the internet came along in 1991, or the web really came along in 1991 with the introduction of HTTP, and we had this bubble in the 90s, the dot-com bubble that occurred during that period of frenzy. We had a crash in the 2000s when we really overinvested in these companies, but a lot of them weren't really delivering the things that they were promising. But then in the 2000s and the 2010s, we get this period of synergy where we got really the actual growth of Google and YouTube and Facebook and all of those companies that came along in the early 2000s. That would be the synergy phase. And now we're in this period of consolidation where we're consolidating the market around Google, Apple, Facebook, Amazon. So what does this look like for crypto? Well, we have the introduction of the Bitcoin white paper, the release of Bitcoin in 2009, and that's really what kickstarted the eruption phase. And from 2009 to about where we are today, until very recently, it was kind of that 10-year period where crypto and Bitcoin was kind of hanging out and not really being very interested, and the people who believed in it were a very small group. But there were a lot of engineers and entrepreneurs kind of toying with it and kind of playing with it. And we now entered, after about 10 years of this, kind of right on schedule, we're now entering this frenzy phase where now the use cases become more clear. Now a lot more people around the world are starting to understand how this technology is powerful and what kinds of services and applications and companies we can build using this technology. And so we're now in this period of overinvestment where a lot of capital is rushing into the space at an accelerated rate. And we are going into this market with our eyes wide open, knowing that we are in a period of frenzy, knowing that we're in a period where there's a lot of volatility and where there's more capital and more money in the space than fact and technology. But we also understand that this is a key or a critical moment in the development of any technology, because a lot of important infrastructure comes out of this space. A lot of the building blocks that eventually facilitate the period of synergy are emerged during the period of frenzy. So this is a very important time in the development of this market. And one of the really two best times to invest in technology and following this framework are the frenzy and synergy, because that's when you get the most amount of exponential growth. The problem with the frenzy is that eventually you have to watch out for a crash, but we'll get to that in a little bit. The one important lesson from this framework is actually what, and we'll get into this later as well, is what should you look for during the installation phase, and that's this section of investing in infrastructure and early use cases, and investing in platforms and the building blocks that allow for crypto networks to exist. So where we're finding opportunities, well, we're looking precisely to Carlotta's framework and understanding that we're early in the development of this market and we need to fund the building blocks. We need to invest in the key pieces of infrastructure that allow for this ecosystem to exist. So we're looking at developer and application platforms. So if you look at something like Ethereum, for example, Ethereum is a developer platform that allows entrepreneurs and developers to build applications on top of it. And so it's kind of what Windows was to the PC software industry. Windows came along and people were able to build software that ran on top of Windows. Windows was a platform. And similarly, services like Ethereum or services like Filecoin, for example, which is a decentralized file storage system, or services like LivePeer, which is a decentralized video streaming platform. These are the kinds of infrastructure that we need to develop in order for us to build more and more and more important decentralized applications. So we're looking for those, for developer services, and part of the reason is that they will accrue the most early value because developers are the first users of this technology. Very few people are using crypto services the same way that they use Facebook and Instagram, because those kinds of consumer services just don't exist yet. And the reason they don't exist yet is because the infrastructure is still underdeveloped. But things like Ethereum and so on, and the examples that I mentioned, are the kinds of infrastructure that will allow for a decentralized YouTube and a decentralized Uber and a decentralized Google, or et cetera, to emerge. But we need to invest in that infrastructure. We're also looking for financial infrastructure. And what's interesting about this particular technological revolution is that it started from a very financial point of view, which was cryptocurrency. With the emergence of Bitcoin, we now have this decentralized currency that allows us to do so many different interesting things, but also creates the opportunity to recreate the entire financial system. And this is also another point that comes up in Carlotta's work. The financial industry is usually one of the earliest adopters of new technology because of all the industries out there. The financial industry is the one that benefits the most from increases in efficiency of communication. And so when cars came along, banks were one of the first people to really use cars so that they could move money more efficiently between branches. And when the internet came along, or networks came along, banks were, when computers came along, some of the early clients for IBM were banks who needed to increase the speed of their processes. And when computer networks came along, banks were also, or the financial industry was one of the early adopters because it increased the speed of communication. Similarly, we're seeing with blockchain, the financial industry is adopting blockchain protocols and blockchain technologies before anybody else because it introduces so many efficiencies to their processes. So we are looking for financial infrastructure and applications in this stage of the market, understanding that some of the early value is going to come from actual usage, and some of the first users are the financial sector. Finally, we're looking for new consumer use cases, and these are things that will develop over several decades, but basically, what are the kinds of things that we can do now that we couldn't do before the existence of blockchains? And so, for example, we see a lot of proposals for people building decentralized YouTube, but we already have YouTube and it works kind of fine. And yes, there will be a point in time in which a decentralized YouTube will be important and will be valuable and will eclipse YouTube. That's probably not going to happen in the next 5 years. That's probably not going to happen in the next 10 years. But what are the kinds of things that we can do with this technology that just we couldn't do before we had blockchains? And these are things like crypto collectibles and non-fungible tokens and crypto art and decentralized games and so on. One of the most recent examples being crypto kitties. People are going crazy over digital collectible cats for the only reason that with a blockchain we can create these unique little creatures and these unique little assets and kind of create these new games that we really can't build under the current on the web system or with a centralized service, because it's not quite the same level of interaction. It's not quite the same kind of activity. This is probably the most abstract and fun place to look at, because a lot of those are hard. Those use cases are hard to imagine, but it's the kind of thing that when they emerge, you realize, oh, this is something new. This is something that we couldn't do before. And so there aren't a lot of concrete examples because we're so early in the development of the market, but you'll be able to recognize them when they come out, because usually they will have communities of people or users attached to them that are very committed because it's just something new. An example of what that would have looked like for the web was, for example, email or instant messaging that came in the 90s. Like email was something that emerged really in the 90s at a level of scale, and it's something that we just couldn't have done before the internet. In contrast, if you think of Google Docs versus Microsoft Office, if you try to build Google Docs in the 90s, we already had Microsoft Office. It just wasn't the right time for a service like that to emerge, but it took took a decade or two for that to really become viable. So let's transition into how we evaluate these potential investments. Now you know where we're looking for opportunities, and the market is now at a point where there's new projects coming along almost every hour, and as it was mentioned before, 95% of them are going to fail. And so what becomes important is how do you evaluate potential investments, and how do you select a team or an entrepreneur to back? And we have this kind of 5-point framework or 5 areas that we look for information. First, we look at the market, then we look at the team, then we look at the technology, then we look at governance, and then we look at cryptoeconomics. The last 2 columns are particularly new to this market. The first 3 columns are kind of more general investor processes in terms of how you evaluate a potential investment. In terms of market, the first thing that we evaluate is whether a crypto network model or the introduction of a token or a crypto asset whether that introduces significant efficiencies to a market. The answer is not always yes. And I'll give an example of when it does and when it doesn't. And if you're trying to build a decentralized YouTube, because the infrastructure isn't there yet, if you try to build a decentralized YouTube right now, it's not going to be better than YouTube. It just isn't. There's not going to be a real advantage to the decentralized YouTube versus the one that we have. Again, there will be in the future, but just not right now. And so when we evaluate opportunities that kind of fall into that bucket, we decide not to invest in them, even though we may believe that the concept and the idea will materialize at some point in the future. It may not be the right time right now for that market. An example of where a token or a crypto asset may introduce significant efficiencies is, for example, decentralized file storage. And bringing back the Filecoin example, you have companies like Dropbox or Amazon that provide storage today. A decentralized file storage system powered by a crypto asset can actually introduce significant efficiencies, because if you create a decentralized file storage system, one of the advantages is that it will never go down. Whereas Amazon goes down about once a year and takes half the internet with it, and we all kind of just wait for 30 minutes, and it makes our lives very difficult for that time. Whereas a decentralized file storage system, kind of like Bitcoin, because it is decentralized, it doesn't go down. And this is an example where a decentralized architecture and a crypto asset does add significant efficiencies to the market, and that may allow for that opportunity to be important in the short term. We look at a bunch of other things, like, for example, we look at whether a particular service is creating an entire new market or competing in an existing one. So, for example, Filecoin would be competing in an existing one because there are other alternatives. But again, we are confident making that investment because we understand that there are significant efficiencies to this model relative to the competition. But there are also examples like the CryptoKitties example that I mentioned. It's creating an entirely new market because it's an entirely new behavior. It's an entirely new application. We also look at standard things like the size of the market and the rate of adoption and whether people are likely to use this or not, and so on. And also more subjective things that are individual to opportunities, whether a team has a market strategy or a market entry strategy, and so on. And what's cool about about the crypto market, is that teams typically publish white papers, which you've probably seen, where they outline basically their business models or the equivalent of their business plans, where they typically describe how they plan to address their market and how they plan to grow. And so you have to do some work to evaluate whether you think that's a sound strategy or not. Second, we look at the team, and first you obviously have to evaluate whether the team actually has the skills to execute on the thing that they want to go out and build. The thing to remember here is that what you see in a white paper is typically a promise, and is not really developed, especially when you're investing in ICOs or something like that. They're raising money to go out and develop the service that they say that they will develop, but you have to make sure that they actually have the talent in the team to develop this technology and develop this product and get it to market. And so you have to look into the backgrounds of the team, where they're coming from, where they worked at before, what's their experience, kind of like run a background check. It's almost like a job interview. When you're hiring someone, you want to make sure that they actually have the skills to do the work that you're hiring them to do. Same thing with a founding team. You want to make sure that they have the skills to actually develop this company. But one of the most important and underlooked aspects in a team that you need to evaluate is whether they can manage a community. And the reason is that crypto networks, unlike companies, they are communities and they are networks and they are decentralized. And so what actually ends up being quite an important skill for a crypto team or an entrepreneur team is to be able to create a community around them who is going to sustain and grow the network, because that is the most important thing. Gone are the days of the sort of Silicon Valley style CEO like Mark Zuckerberg, who comes in and hires a bunch of people and executes. Here you have to develop a community, and you have to get a community of users, because those are the people who are going to be buying the token or who are going to be buying the cryptocurrency, and that's what's actually going to lead to the growth of that token or of that crypto asset. And so if the team doesn't have the skills or the talent to manage and grow a community, then they're not going to be able to manage and grow a community of people who have the token, and so the token's not going to grow. So that's a very important thing to look for in a team. in the technology, there's a very basic question, which is, does it actually work? And that is one where you have to be careful, because a lot of people are out there promising things that don't actually work, or that don't exist, or won't exist in the immediate future. And I'll bring back the example of a decentralized YouTube, because it's an example of, you really could not build a decentralized YouTube right now because the infrastructure isn't there. You really couldn't. It could not exist. And so if a team comes in and goes, we're going to build decentralized YouTube and it's going to come out next year, no, it's not. It's not going to come out next year because we don't have the building blocks. And so you have to look at, and you know, it may take some level of technical sophistication to really go deep into it. But if you're not technical, you can also rely on the work that other people are doing, because these are open networks and open source protocols, and typically there will be forums and communities where people are discussing the technical merits of different services. And so you can go on Reddit, or you can go on Twitter, or you can sort of read what other people's comments are on the technology of this service before making an investment decision. Governance. Governance is a particularly important one in decentralized networks. And the reason is that, as I mentioned, these are not companies in the traditional sense. There's not like a CEO with a team that's going to build a business the same way that, you know, you built Facebook, or you built Google, or you built Amazon, and so on. And so this kind of ties back to the importance of community management, is how does the governance of the core team or the developer team, and how does the governance of the protocol work? And the reason the governance mechanisms of the protocol are important is because it determines whether you are able to trust the protocol or not, whether you're able to trust the crypto network or not. And the reason that's so important is because if I'm going to buy a crypto asset, I need to trust that the service is going to work, and I need to trust that the economic model of the token is not going to change. So, for example, in Bitcoin, the governance model is based around the computers connected to the network running the Bitcoin protocol. And the Bitcoin protocol specifies that there will be only 21 million Bitcoin ever created, and it sets the rules for how those Bitcoins are created over time. And so as an investor, I can look at that and make a decision around, okay, if I'm going to buy Bitcoin, I am kind of trusting that there will be maximum of 21 million, and that it requires the change of the protocol in millions of computers in order for that to be different, or for that to be changed. And so I can trust that governance system. I can trust that the Bitcoin economic model isn't going to change. The reason that one easy way to understand why that is so important is we have governments today that we don't trust, that change the economic model all the time and create inflation and create all these things. It makes it really hard for us as participants in an economy to trust that model. And so we look for good governance models within crypto networks. And basically, one way to reduce it to a more practical point is, who has the authority to change the rules of the protocol? Is it the core development team? Is it a single person? Or does it require the entire community to participate in that vote? In the case of Bitcoin, it requires 51% of the mining community to participate in a vote to change the economic model. And as Bitcoin grows, then it requires more and more people to agree to that change so you can trust it more. If there was a single person in charge of deciding whether Bitcoin goes from 21 million to 42 million tomorrow, then I wouldn't trust it all that much, because I don't know that person, and they can wake up one day and make a decision that goes against what I wanted. And then finally, we look at the cryptoeconomics, and this is more of a study of the incentive system within these networks. As you've learned, these networks are backed by these incentive models that incentivize people to come out and contribute infrastructure to these services. In the case of Bitcoin, just to bring that example again, the Bitcoin protocol rewards miners for contributing computing power to keep the service running. And so the miners make an informed decision around whether they want to contribute infrastructure to the services and so on. So when you study Bitcoin's cryptoeconomics, you can go, okay, miners are paid in this way, and so that's going to allow people to come in and contribute infrastructure. And so that is a sound cryptoeconomic model. Similar thing for Ethereum, miners are compensated for running computation. Similar things for Filecoin, miners are compensated for providing storage to the network. And this is going to be different from network to network, because you have different services that are being provided, and so the economics are different. The service of providing a payment system is very different from the service of providing file storage. It's very different from providing decentralized video, for example. And so you have to kind of evaluate whether the model is constructed in a way that's really advantageous to the network. One way to think about it more concretely is actually thinking around, for example, within the realm of cryptoeconomics, how much of the token is a team keeping for themselves? We have seen teams like, for example, Ripple has 70% of XRP supply for themselves. That to us is bad governance and bad crypto economics. Whereas something like Bitcoin, there wasn't a single company or team holding back a bunch of Bitcoin for themselves. We see teams that hold back 10%. That feels right in terms of their own compensation. They hold back 20%. That feels okay. When we see a team that says, we're going to keep 50% of the token, that makes us go, no way, because then you're concentrating too much of the value, and then you're not really building a good crypto economic model to advantage the community. So these are the 5 kind of pillars that we look for, and there's a lot to unpack in all of them, and in terms of your own journey into learning to invest into these things, it will take a lot of trial and error and observation to understand what are the important variables, and you will develop the skill, and you will develop the sense for whether something's properly constructed or not. But one of the cool things that you can really rely on the community. No investor in this market here is really isolated. There's really a wealth of information out there, because you have a lot of people looking at these things and making commentary and having debates online, and so you can really rely on the communities behind these projects to determine whether they're properly constructed or not. And so, for example, I am not a technology expert in the same way that someone who's building a crypto network from scratch is, so I can't tell you if the code of a crypto network is properly constructed or not, but I rely on the fact that if there's a community of developers around the service and they all trust that code, then I can kind of rely on that as well and focus my time more on the things that I can evaluate individually as a person, like the market and the team and the governance. And so you don't need to know all of these skills, but the skill that you do have to develop is one of really doing research and understanding what people think, or really looking for other people's analyses of these pillars. And what's cool is that people do put them out there. People write blog posts, and they contribute to forums, and they comment and have conversations around all of these aspects. And so you can combine all of that before you make an investment decision. So we're going to end with what's in the future. How do we expect, at least as a firm, that for this market to evolve? And we bring back Carlotta's framework, and left it for the end, because, as I mentioned, we believe that we're in this frenzy stage, and the inevitable end for a frenzy is a big crash. And we don't know when it's going to happen. If it follows Carlotta's schedule, it's going to happen in the next 5, 6, 7 years, perhaps. We don't try to predict when it's going to happen, but rather invest in the right things and invest with conviction and really invest for the long term. And it's like that example of Amazon, where Amazon had this meteoric rise during the dot-com boom, and then the dot-com bubble happened, and then it crashed massively. But then still now Amazon is, 20 years later, still the most valuable company in the world, or grew to be the most valuable company in the world. And so rather than try and predict when the crash is going to happen, and how it's going to happen, and how big it's going to be, or how high we're going to go before it happens, we find it to be better business, or just better investor practice, to select the right investments and select the right opportunities and really commit to the long term. Because if you bought Amazon in 1997, you had a big rise, and then you had a big crash, and if you had sold Amazon after the crash of 2000 and it would have lost a lot of money, you would have lost out on the meteoric rise that Amazon had after the crash. And so similarly, we believe in selecting the right teams, selecting the right opportunities, selecting the right networks, understanding that we are in a period of frenzy, understanding that there will be losses, understanding that we need to build a portfolio of different opportunities and not put all of our eggs in one basket, and to invest intelligently and select projects intelligently, but also knowing that we have a long way to go. And so this is a really long-term opportunity here, and it will develop over a long period of time. And it's so much fun, because there's so many things that are new and different here. This is unlike investing in companies. This is unlike investing in any other asset class. And so a lot of the things around, for example, how to value these things, how to think about valuation, how to think about all of the 5 aspects that I showcased earlier, we're still learning and figuring all of this stuff out. And so it takes really more investors coming in and thinking about this stuff and really making their own decisions to develop the frameworks to really understand this space. And that's just fun, because investing in equities now, it's pretty boring. The reason I left USV and my partner Chris left ARC is because we just didn't want to be investing in traditional businesses anymore, because finding this stuff out and learning this stuff in real time as it develops, it's just a lot more fun. So we're going to go to Q&A, and I'll cheat a little bit because I'm going to start with one question, which is one of the most important ones, which is, why does this matter? Why is crypto so important? Why we just went through a whole bunch of information, but there's one thing that gets me up every morning and that gets me working in this space every day, and that is the mission of decentralizing data, wealth, and power. If you take the internet analogy, the internet as a decentralized set of protocols, as a decentralized network, came to revolutionize the information industry and came to revolutionize the communications industry. Now we live in this magical world where we can communicate with anyone in the world pretty much for free. Now we have a similar kind of technology that is decentralized, that is open, that has the potential to be as large as the internet itself, but it's centered around open data and open financial systems. And so we have just as the internet democratized access to information and democratized access to communications, now we have a technology that allows us to democratize access to data and democratize access to wealth. Because now, as I mentioned earlier, now any individual can participate in these highly leverageable investment opportunities that have a lot of potential value in them. And what that's going to result in is that we're going to be able to spread some of the value more broadly around the world and create more value and more wealth to the world, and ultimately decentralize power and decentralize the world further and further. What we've seen as our society has developed over the last several hundred years is that with every new technology, power spreads a little bit more, a little bit more, a little bit more. And we've seen what the internet has done to society over the last 20 years, and I can't wait to see what crypto is going to do to society over the next 50 years. That's all I got. Thank you.